I guess I want to start looking at this first, Jeff, just from the perspective as an investor. You may be invested in a rival competitor, but I think the fortunes of the two companies will probably fare the same. If one is able to maintain profitability, it's probably going to be something where both of them can. And you guys can also act as anchors around each other's necks. So what do you think in terms of the path to profitability, both for Uber and for Lyft?
Absolutely. Well, I think when you think about these very capital-intensive businesses, it's all about driving economies of scale on the core business that drives the bulk of the revenue. So both companies need to drive increasing economies of scale on the core ride-sharing business.
If that's the case, Uber's doing a better job.
Well, I perhaps disagree. So I think a lot of the things they're doing actually don't drive economies of scale in the ride-sharing business. It's not clear that the Uber Eats is actually driving economies of scale on the core rides business. It's not clear that a lot of the global exploits they've pursued are driving economies of scale, contrasted versus Lyft, which has just been very focused on growing market share in the United States, getting more riders per hour into cars. I think the jury's out. I think Lyft's doing a phenomenal job by being more focused.
Who has just the number of drivers? They have more drivers, but how does it kind of break down?
I don't know the exact breakdown. Obviously, Uber's scale is much bigger than Lyft. But that said, the reason why Amazon was able to drive such strong economies of scale is almost everything they expanded into, particularly Amazon Prime, was driven toward selling more SKUs on the core Amazon business. Whereas all of these things Uber's doing, they don't necessarily put more human beings into cars. So I actually don't agree necessarily with Mike's analogy, although I respect him tremendously as a journalist.
Mike, lay out your analogy.
Yeah, no, I totally take your point, Jeff. And I think a lot of the analogy that they're going to try to make work for them is essentially the idea that, hey, Amazon lost a lot of money for a long period of time as a public company, and you got to let us do the same. And I kind of look at it similar to how Snap was comparing itself to Facebook rather than Twitter when it was going public. They just want the benefits of like a semi, plausible comparison, but there's a good amount of problems in that, direct analogy. I also think that they're like trying to say, hey, we might have something like an Amazon Web Services, an AWS up our sleeve that might happen at some point eventually. You just have to give us the room to build out that platform over time.
What do you think that platform would be, Mike?
Yeah, so I think to Jeff's point about driving things back to the core business, something that Uber's been hinting at for a long time is this idea of like memberships and maybe transportation as a subscription or something that you can sort of recurring do over time. So to the idea that it's more like Amazon, maybe like a Prime level thing where if you pay a monthly or a weekly or some sort of fee, that gives you access to a whole suite of services inside of Uber, and that sort of like drives things back to their core business.
Yeah, super skeptical that'll work.
Is there a scale, because that requires a scale piece to it, and to some degree requires that actually there's less usage, right? You want people to effectively overpay and then not actually use the service. And Amazon found, remember initially for a lot of Prime subscribers actually, it was costing Amazon money initially until people started spending even more and more and more. The question is, can you replicate that? But this requires actually paying people by the hour as opposed to a physical product.
Absolutely subscale. And I think one tell on this is Bezos never talked about Amazon Prime until it was launched. The fact that Uber is aggressively pitching a membership type subscription thing this early on, I think says a lot about its ultimate viability, which I think is many years off from it being potentially viable.
Mike, let's get your analysis just in terms of what has to happen for either of these companies to get to profitability. Can either one be profitable as long as they are still locked in this stiff competition?
Yeah, no, I mean, it's a good question that I don't actually have the answer to yet, which is funny. Someone was asking me the other day, have these companies built the greatest, ride-sharing and transportation empires in history, or have they built the most efficient capital burn machines that Wall Street and Silicon Valley have ever seen? And, we keep hearing about these points where the ride subsidy wars are going to end at some point, and we haven't really gotten there, particularly because more entrants keep coming to the market. And For Uber, that's a big problem because they're all overseas and they start fighting wars on a bunch of fronts. So there's this far-off day where maybe they stop having to burn as much cash to keep winning folks over, but I don't see that quite in the near future, at least.
Jeff, you've got to have a different perspective as an investor. I guess in some ways this is a big game of musical chairs, and you just want to make sure you're in one of the seats when the music ends and the money stops.
You know, I think that's definitely partially right. You really have to delineate. You know, my partner at Bedrock, Eric Stromberg, says this great delineation between capital-intensive businesses and capital-efficient businesses. And what we're seeing now is the first wave of technology IPOs with businesses that are really capital-intensive. You've got Uber, you've got Lyft. Now soon we're going to have, Postmates, DoorDash coming out. These are all very capital-intensive businesses versus the prior wave, Facebook, Google, Snapchat, capital-efficient. Now with capital-efficient businesses, they're easier to disintermediate.
Somebody can always jump in and be a competitor, but with a capital-intense business, you got to have the war chest before.
Exactly. So long term, I actually do think, you have to spend a tremendous amount of money. It's very dilutive. You have to raise a lot of capital, but ultimately, if you're in one of those seats at the end of the day, that's a very durable business. It's harder to disintermediate.